Good evening, investors. So today, Chris Wood of Jefferies has added a bulk position in one of the Adani stock by selling Reliance. Now, why did he do this? We will discuss. But today, Adani stocks were on total fire. Full group was in green today. Adani Power 12.36%, ATGL 7.33%, Adani Enterprises 4.72%. The reason why Adani stocks were sky high today because SEBI has now given them clean chit in Hindenburg case. For those who don't know, Hindenburg is a short seller, and earlier they have made some allegations on Adani Group that they are pumping their stocks by infusing their own money through offshore funds. So SEBI investigated, gave clean chit to Adani Group and has said that all the allegations which were made by Hindenburg were baseless and has completely dismissed their all findings. Now this is very big news, but it is not something which is completely uncertain because by August 2023 itself, out of 24 investigations related to Adani Hindenburg matter, 22 were already final. But still, market likes complete certainty. That's why you can see all Adani groups were totally rocket today. Now, what is my stance? I will tell you. But before that, Chris Wood of Jefferies has increased his India portfolio allocation in two Adani stocks. Now, two Adani stocks carry almost 10% of his weightage in India portfolio. One is Adani Ports with 6% weightage and another one is Ambuja Cement with 4% weightage. Now for Adani Ports, he has not disclosed the reason, but for Ambuja Cement, his main reason is a GST rate cut on cement from 28 to 18%. Now cement carries a big cost in housing and infra sector, and from the past few years you have noticed we are riding a good housing cycle and infra cycle. So logically we might see some good volume growth in Ambuja Cement in upcoming quarter after the GST rate cut implementation. Now, if you are aware of Chris Wood investment ideology, then he is a long-term value investor. So he might have seen some value in Adani Port stock. But if you ask me, then I prefer to stay away from Adani stocks. Why? Because they have a very low domestic institutional holding compared to other large cap and mid caps. If we, for example, say Adani Ports and SEZ and check its domestic institutional holding, then we can say DII holding is almost 15.15%, but this is majorly held by LIC and the index funds because index have to hold those stocks which are the part of index. Apart from that, no active mutual fund has Adani stocks in their holding. Plus, Adani companies have a very complex business structure. They have hundreds of subsidiaries. So, as a serious investor who prefer value investing and prefers reading financial results in depth, he has to study each and every subsidiary in order to make some conclusion. So I prefer to avoid this. Now this is not a sell or buy recommendation on Adani stocks, and honestly whenever I make a bearish view on any of the stocks, those stocks do exceptionally well. So I don't know how these stocks are going to do, but I prefer to stay away from these stocks. Now coming to today's performance, Nifty 0.38% down, a break in the ongoing momentum. However, mid cap and small cap did marginally well. Mid cap 0.01% up, small cap 0.14% up. But between all of this, PSU banking space is doing exceptionally well. Today Nifty PSU Bank was 1.28% up, and from past 6 months it has already given a rally of 25% overall as a sector. Now, in order to understand this space, I have plotted numbers of all the PSU banks that are listed in our stock market and have tried to make some conclusions. But before that, let's try to understand what are the sentiments that are running this rally in PSU banks. So few days back, Department of Financial Services has organized an event called PSU Bank Manthan 2025. It was almost attended by public sector bank top management, regulators, experts, academicians and practitioners. Now there they emphasize that they are targeting at least two public sector banks in top 20 banks of the world. Their target is to increase their asset base, book size, technology upgrades, etc. etc. Plus, RBI earlier has also eased some lending norms to infra sector, and PSU banks have more exposure to infra sector compared to private sector space. So sentiments are good around public sector banking space, but in the long term what matters is numbers, not sentiments. So here I have plotted numbers related to 12 public sector banks. I have compared them across 7 metric. First one, price to book, that is the valuation metric. So price to book, lower the better, but not necessary. Banks with good ROE, ROA usually get higher price to book. Next is ROE. It is percentage of profit that bank is making on its own money. Next is ROA, that is return on assets. ROE stands for return on equity. I forgot to tell you earlier. So ROA, return on asset, it is the percentage of profit that is made on bank money plus depositors money. So in case of ROE, ROA, higher the better. Next comes GNPA and NNPA. GNPA means gross non-performing asset and NNPA means net non-performing asset. For example, say State Bank of India has 2.76% of GNPA, and let us suppose State Bank of India has a loan book size of 100 crore rupees. So out of that 100 crore loan book, 2.76%, that is people with 2.76 crore of loan have defaulted on their EMIs. Now loans are asset to the banks, and those people who have taken loan from the bank and don't pay EMIs, they become non-performing assets. Now what is NNPA? So out of 2.76%, SBI will keep trying to recover its loan, but as of now SBI has set aside some profit and it is thinking it won't be able to recover 1.02%. So in both GNPA and NNPA, lower the better, higher is very dangerous. Next is NIM, that is net interest margin. It is simply difference between the interest rate at which the bank is giving loan minus interest rate at which it is paying to its savers, FDs or bonds. For example, SBI, for example, pay you, for example, say saving 7% on FD, and from that amount it gives loan at 10%. So NIM, that is net interest margin for State Bank of India, will be 10 minus 7 equal to 3%. Next comes cost to income ratio. As the name suggests, it tells how much of the total income earned by bank goes towards running the bank. In case of cost to income, lower the better. That means lower part of income is required to run the bank. Now I have done color grading for each metric. Green means the best, red means the worst, and the scale automatically adjusts the color from best to worst. So for example, you see Canara Bank has the lowest valuation as of now, but it also has the lowest net interest to margin as well. If you see Indian Overseas Bank, it has been given a very high valuation of 4.3, but if you see its other metrics are very good, and I think its other metrics are very good, that's why market is giving them a good valuation. ROE is 19%, ROA 1.14%, GNPA 1.97%, NNPA 0.32%, very lowest, net interest margin 3.04%, cost to income 44.22%. Now if I have to shortlist some banks to study, then first Bank of Baroda, very good valuation of 0.99, plus other matrices are also very good, none of them is in red. ROE 15.05%, GNPA is very low, 2.28% compared to other PSUs. Next, Indian Bank, valuation okay 1.2, but NNPA is very low, 0.18%, and cost to income is also very good, 44.77%. And third one is Bank of Maharashtra. Although price to book is little high, but if you compare other metrics, ROE, ROA, GNPA, NNPA, NIM, cost to income, then they look very good. Now I have created this table using AI tools. So before taking any conclusion basis this data, please recheck these numbers on your end as well. Now coming to other updates, Deutsche Bank has raised gold price for 2026 to $4,000. Currently it is trading at $3,700 per ounce. So roughly 10% upside from this price. Their main reason is because US has cut their interest rates, and in my earlier videos also we have discussed that whenever US rate cut happen, dollar weakens and other asset classes suddenly look very good. Plus, Fed has also given indication of further 2 rate cuts in this year as well. So that is also a positive factor. Gold in the past 1 year has already rallied 50%. So does it make sense to invest now? Actually, no one knows how long this rally will keep going. But historically, we have never seen a deeper correction in gold. You have never seen news that gold has fallen by 50%, 60% or crashed. In gold, we might see some time correction that, for example, say for few months or for few years, gold price has been stagnant. But we have never seen a deeper correction in gold prices. So that's it for today, investors. I will meet you in next video. Thank you.